I'm Matt Gill. I'm a member of the board of the IAFE and co-chair of the IAFE Technology Committee. And on behalf of the association, very pleased to have you all here today. It's a great turnout on a rainy afternoon. I think we had record registrations for this topic, so we obviously have hit an interesting spot in the market. And in fact, not only do we have this room here, but we have another room that's pretty much filling up now where we are actually telecasting into. So very exciting afternoon here indeed. For those of you that aren't too familiar with the IAFE, we're a professional association focused on supporting the quantitative finance industry. And we're fortunate to have many of the industry's leading theorists on many of our boards, including Myron Scholes, Steve Ross, Bob Merton, Bob Jarrow, Emmanuel Derman, and the list goes on. But we also do a lot to bridge the worlds of academia and Wall Street, but we also have a lot of very professional focused associations or committees focused on areas like investor risk, which is one of our very active committees, which is looking right now at the issue of hedge fund disclosure and valuation. We also have a committee working on credit risk, operational risk, and as for today's session, the technology committee. And in the past, we've done sessions on reference data management, ASP solutions and their application for risk management, grid computing and parallel computing and how that's being used in the risk and valuation industries, and also done some work on data standards, specifically looking at FIX and FPML. So we're pretty active in the area that bridges quantitative finance and technology. And today's topic, again, brings in those two and obviously one of great interest. Before we get down to business, I'd like to thank our sponsor, Vayu. They have their desk out front, so please spend a minute or two with them after the session. And I'd also like to thank our gracious hosts, Goldman Sachs, who allow us to put on these events on a pretty regular basis here. I'd also like to remind you that our press policy is that everything that is said in these sessions is strictly off the record. However, we are recording the speakers to be telecast to the other room and for distribution to our membership down the road. I'd like to encourage you to take a look at the membership applications, the membership information I think each of you has in front of your desk. It talks about the different types of categories that we have in terms of membership and the benefits. And obviously, a lot of you here are not members, and we'd love for you to take a look at what the association is all about and if that interests you. In fact, at the bar afterwards, members get first dibs. So we will be taking applications strictly right after the session. One change to the session, we've had a change in our program in that Randy Grossman, who was going to be our moderator from IDC, is unfortunately tied up logistically with a storm in Boston, which has shut off all communication to that great city. And Debbie Williams, his boss, we're fortunate enough, is here today and will be moderating. Debbie, for those of you that don't know her, is the Group VP of Capital Markets and Risk Management at Financial Insights, which is an IDC company. So without further ado, I will hand it over to Debbie, and we can get going.
Thanks very much, Mac. So I guess as they say today, the part of Randy Grossman will be played by Debbie Williams, and I guess I could have just impersonated Randy, except if there were hard questions, then I would have gotten in trouble. Although that's why you have panelists, right? So the goal of tonight is to make this an interactive forum, and I know with I don't know how many people are actually here, but we had 600 registered, so 600 people being interactive could get a little out of hand, although my experience is that actually the more people you have, the less interactive people tend to be. So I'm actually kind of hopeful that by breaking us up into smaller groups, we'll still keep that interactive sense of the evening. The panelists are all really looking forward to taking your questions, and I hope that you will jot them down and raise your hands and actively engage on the topics that are interesting to you. We have some prepared statements tonight. The way the event's going to take place is after my little intro is over, each of the panelists has prepared a couple of remarks talking through a little bit how they create, test, and evaluate the algorithms in their organizations. Then we're going to open to questions. I have a couple to get the ball rolling, and I'm hopeful that after we've responded to some of those on the panel that you guys will kick in with questions of your own. There are a few seats in front if you want to come to the front. Let me introduce you a little bit to our panelists. You do have their bios on the inside, so I'm just going to make my remarks very brief. In the order in which they will be opening, our first panelist is Robert Cassell. Robert is Vice President of Electronic Execution Services at JP Morgan. Along with other things, his responsibilities include developing their algorithmic trading strategies, market impact and timing risk estimation models, pre-trade modeling to assess difficulties trading and evaluate alternative execution strategies, and trade list optimization. He's also developed analytical decision-making frameworks to determine appropriate execution strategies for investors given their goals and objectives. Rob's been doing this stuff for a long time and has published extensively, and we're very happy to have him with us tonight. John Butler, Vice President of Execution Strategies, Equities Technologies, right here at Goldman, will be speaking next, and I think we're actually in order. John is currently responsible for algorithmic trading. I understand that the appropriate acronym is GSAT, GSAT.
That's correct. Goldman
Sachs Algorithmic Trading, and John will be reflecting a little bit on how things happen here at Goldman, and also contributing his experiences over the years all over the world, as it turns out, working on quantitative strategies. And then finally, so that I am not completely overwhelmed by the sexual balance of the panel, we have Linda Giordano joining us from QSG. Linda is a product consultant there with their group, and joined them in 2004. She oversees execution quality-related research and consulting services, and prior to that was vice president and head of trading research at Instinet. Linda will be our last presenter of the opening remarks. I know if Randy were here, he would make some brilliant and stunning comments about algorithmic trading and its impact on all of us. And so you just have to imagine great things that Randy would have said if he were here. And I am not going to attempt it, but I'm going to pass it on to our first speaker and allow him to make the brilliant remarks. So please help me in welcoming Rob.
Great, thanks, Debbie. Let me make sure I can work this. Okay. For my discussion, I'm going to really try to stick to the theme of the seminar, of this talk, which is really algorithmic trading. How do we know it's working? Most people involved in algorithmic trading say, it really comes down to the trading costs. How do we manage trading costs? What do we do about trading costs? But I want to start by first introducing the trader's dilemma, something that's probably, again, be well known throughout the industry, at least it is for traders. And that is, if I'm a trader, I have a large position. If I execute it too aggressively, I'm going to incur too much market impact, so I'm going to incur a high cost. But if I trade passively over time, I'm incurring a large quantity of timing risk. That, in turn, can make my costs even higher than what they would have been if I traded aggressively. So what am I to do? This problem was really addressed a few years ago by Almgren and Chris. They presented a great framework for really balancing the trade-off between market impact, timing risk, really transaction costs and risk. And it's just known as the efficient trading frontier. So I'm going to bring everything back to transaction costs and the efficient trading frontier. Okay, let me begin by, first, what is algorithmic trading? Well, we all know it's computerized executions of an order of a list, but what algorithmic trading really requires is more interaction by the trader, by the client, by the investor. A manual trader will make adjustments. They will know when to trade aggressively, passively, but an algorithm really doesn't. So we need to specify exactly to the algorithm what do we want it to do. Part of this decision-making framework, there's macro-level decisions that are made by investors, and that's what I'm really going to stick to. This is first, really simple, selecting a price benchmark. price benchmarks could be open, close. It could be VWAP, previous night's close, things like that. The second part is the urgency or risk. Do I want to trade aggressively? Do I want to trade passively? Do I want to balance my market impact and risk? And then finally, it's market adaptation strategies. A funny thing really happens when we model, and that's really that things are supposed to happen do, but in the real world, what we see is those things that we modeled for don't happen. So we need to specify to the algorithm how is the algorithm to react to changing prices, changing volumes, things like that. So let's talk about price benchmarks. We can see right here, again, I'm bringing everything back to transaction costs and the efficient trading frontier. The first chart I have right now is showing the efficient trading frontier for 3 different benchmarks. Arrival price, previous close, and the day's close. It's important when we do go through our algorithmic decision-making process that we really bring the ETF down to our benchmark. We can see that it's showing the trade-off. I'm sure if we can see the light here. Trading very aggressively when I have a high cost, less risk. If I trade passively, a little lower cost, more risk. But now why are there 3 different ETFs, one for each benchmark? Well, first, this is an example. Let's assume I'm buying a stock and my decision price was last night's close. Stock closed at 30. Now it opened at 30.50, 30.75, and I have to buy it. So I just incurred this price movement. The stocks moved 50 cents, 75 cents on me. So that forces the curve upwards. Now, why is the day's closing price bench ETF lower? Well, this is interesting. When we get down to market impact is really 2 components. It's a temporary market impact, which is, of course, due to your liquidity needs and the immediacy of executing the order. And there's this permanent impact, which is due to the information leakage of the order. Now, this permanent impact is projected into the closing price or any type of future price. So what that does, when we compare ourselves, the performance to the closing price, it will shift the efficient trading frontier down. Okay. Next, let's move to this urgency risk aversion. The second step in our algorithmic decision-making process. Well, getting down to once we know here we go. I just skipped a bunch. Once we have defined the efficient frontier for the appropriate benchmark, we need to specify where on that ETF we want to be. A couple of ways of doing this. One is we want to target a specified price. We may have targeted some sort of cost. That may have been used in our portfolio, our investment optimizer. Another way is we may be looking for a level of urgency or risk aversion as it was presented by Almgren and Chris, or we may be looking for some sort of strategy that will maximize the chances of outperforming a certain price or cost. This comes down to it's really a personal decision of a firm, but the way it affects the decision-making process is like this. Let's suppose that my I have a specified cost of 5 cents a share. We can see right here, I actually changed the mapping on this ETF. I'm now mapping cost and POV rate on how much of the day's volume, how much of the market volume do I want to participate with. So when we look for, if I want to achieve a cost of 5 cents per share for the close, I'm incurring a cost of a POV rate of 25%.
What's POV?
Oh, POV, good question. It's percentage of volume. So if I want to stick with a percentage of volume of 25%, if 100 shares trades in the market, I want to trade 25 shares. 1,000 shares trades, I want to do 250 shares. It's just a way of specifying to an algorithm how quickly or how passively I'm going to submit orders to the market. How quick do I want to execute? Now getting into arrival price, since the arrival price is a little higher, I don't want to incur as much market impact as I did for the closing strategy. So we can see I need to trade a little more passively. And finally, if I'm going on last night's close, there's been a lot of price movement. I exaggerated with the 50 cents, 75 cents, but I may have to trade much more passively, maybe a POV rate of 10%. Okay. Now this is a really tough decision to make for individuals, investors, even myself. So it's really essential that whoever's providing algorithms really provides a suite of analytical trading tools. Pre-trade analysis is really necessary, so is portfolio optimization. And if anyone has questions on these two, definitely hit me during the Q&A or afterwards. Could talk about that, all night if you like. Okay, now getting back to, let's suppose that I'm a rival price person and this is my preferred strategy of POV rate of 20%. I derive this strategy under expected market conditions, and that's price movement, volume profiles, the number of other participants buying and selling the stock. But all I know is it's not going to be that way. So I need to specify to the algorithm, how should the algorithm adapt to these changing market conditions? I'm looking right up here. I'm showing 3 different strategies. One is, okay, do nothing. Just stick at 20% over the trading horizon until you finish the order. I say this is more of a random walk, efficient market hypothesis type of investor. The main type of adaptation strategy we use in the terms deviation strategies, also price-based scaling. I'll call it aggressive in the money, AIM. And that's as prices become more favorable, I'm going to trade more aggressively. As prices move away from me, I'm going to trade more passively. This is what a lot of algorithms do, and I'd say some of that broker-dealers do a very poor job in. Algorithms aren't as transparent as they should be, and broker-dealers aren't giving a fair representation of the outcome, the cost consequences of these algorithms. It's something that myself and the other people I work with are really trying to address. We want that transparency. We want fair representation of these cost consequences. Okay, so what does this mean to us? The first graph over here, figure A, we can see that static or just do nothing, don't change the strategy, is shown here with a red normal curve. Okay, a strategy that's aggressive in the money. Let's say that static strategy, is in blue. We'll have an expected cost of C1, and here's the range. Now, the strategy that's aggressive when I'm in the money, prices become favorable, I'm going to start executing a little more quicker, a little more aggressively. What we find with these strategies is we're going to have a lower cost on average. So going from C1, we're going to have a lower cost, we're going to have C2. So in my example, maybe the nickel went down to 3 cents a share. But what happens is, since we're trading aggressively, we're limiting our opportunity to get these really nice, favorable prices. You could say, okay, I'm fine, I like the lower cost on average. But the other thing that these price-based scaling strategies do is, look at this increase in risk exposure over here. You have a much higher chance of incurring these 15, 20, 25, even 50, 75 cents a share executions. For anyone picking these, it's really important, essential that broker-dealers provide these tools that everyone is comfortable with what happens, what can potentially happen with the algorithms. Now let me move to another type of algorithm. Passive in the money. Let's call it PIM. This is a strategy that really follows the Arrow-Pratt risk aversion methodology. And that's as prices start becoming more adverse, it starts moving away from me, I'm going to start executing a little more quicker. I'm going to do this so I limit my potential high losses. As stocks move in my favor, I'm going to trade passively. I'm going to, good prices, great, I'm just going to hang out, keep taking the good prices. Now what this does is, again, starting with that base case, the cost of C1, a passive in the money strategy will shift the cost a little higher. Maybe that nickel goes to 6, 7 cents a share. But the importance is right here. You can see that there's much less, and the passive in the money is shown in red. You can see there's much less opportunity over here on the right. So we're really protecting ourselves from this bad performance or these high cost performances. And we're also opening ourselves up to these potentially great executions, great trades. But of course, it's coming with a slightly higher average cost. Again, all of this is personal preferences of an investor. You can incorporate a lot of the expectations for the price movement, market movement, or even just the stock alpha and specifying what type of algorithm you want, what type of adaptation or deviation strategy. I'm saying it's just important that these things be evaluated and analyzed before selecting the algorithm. I know a lot of people have really catchy names for algorithm, Tarzan or this or that, and it really doesn't. A lot of times I look at it and don't know what it means. So it's important, and I mean even reading the explanations, it's important to understand how your decisions are going to affect this cost profile, the cost consequences. Okay, now let's get down to measuring performance. Let's get back to the theme. How do we know if an algorithm is working? Well, first I just want to show a couple of other things and really say that we can neither measure market impact, and market impact is really defined as the price movement in the stock due to U.S. specific trade or order. So we can neither measure market impact or even differentiate market impact from total trading cost. Okay, why? Well, first, in the market, if I'm trading 50,000 shares of Cisco, how much of an effect am I doing? Even during my trading window, even if it's half hour, what am I really doing? Well, there's a lot of market and sector movement in the stock. That's probably dominating or could be dominating the market movement. Also, there's volatility and idiosyncratic risk. How do I know anything in excess of this market movement or sector movement is my market impact? I don't know. There's this varying, intraday market profiles. Just volumes aren't doing what I expected it to be. And finally, what I think is the most important reason that we can't measure market impact at the trade level or child level is there's so much co-integration across customer orders. And what I mean by co-integration, it's my trading, my market impact is affecting the market impact of my colleague, of Debbie. Let's say Debbie is executing a stock. She's trading 20% of the day's volume. She's selling 20% of the day's volume. And I'm buying 10% of the day's volume. Well, if we're both executing, if we're both trading the stock over the same time horizon, just law of supply and demand, Debbie's going to push the price down more. So performance is going to show that she's getting worse prices, but it's going to show me, someone who's doing a large quantity, 10% of the day's volume is getting this great performance. So anyone measuring my algorithm, say it's great. Anyone measuring Debbie's algorithm may conclude that, this algorithm isn't performing well. So which is, tough to assess algorithms like that. Now let's look at another scenario. Let's say same exact situation, but I'm hyper aggressive. I want to execute 10% in the next hour. Debbie's very passive. She's executing over the day. Well, now there's an imbalance in the beginning. I'm dominating. The buy order is dominating the market. So we're going to see the market price push up due to my pressure, because my 10% in an hour far exceeds Debbie's 20% allocated over the day for that same first hour. So we're going to see me pushing the order up, and then it's going to come down due to her selling pressure. Now, anyone trying to evaluate the performance of this algorithm, for me, is going to say, it's horrible. Usually you get lower costs, but again, I said I'm hyper-aggressive. There was a reason I wanted to execute that many shares in that hour. I may have had an alpha view of this. So it would be tough to say that my performance is higher than average implies it's a poor algorithm.
Actually, Rob, I'm not passive at all. I'm quite aggressive. We need you to wrap.
Okay. Okay, just have one more slide after this. But you can see the point that measuring Debbie's performance would say, it was great performance in the beginning, and then the algorithm performed poorly at the end. Now I'll just jump to the last slide, but what do we do to measure algorithmic performance? Well, we need to know the strategy. We need to know the parameters. This is exactly those 3 steps I mentioned, part of the algorithmic decision-making framework. I showed that the deviation strategies are going to skew that cost profile. So we're going to have an expected cost and risk, and also a skew. So anytime, any statistical analysis, when the data has different moments, mean, variance, skewness, kurtosis, you can't compare across orders, or even within the same order execute over the same time period. So we need to normalize these statistics. Same way we typically in statistics, introductory, we normalize using the z-score. Well, now we need to normalize a new performance measure that accounts for these second moment skewness and the third moment skewness, fourth moment of kurtosis. Now, when we do this, and everything was background until just now, how do we know the algorithm is working? How do we know we're getting what the algorithm is doing what's been advertised. Well, when we standardize our performance, our executions, adjusting for the 4 moments, expected cost, risk, skewness, and kurtosis, we should have performance mean of 0, variance of 1, skewness of 0, and kurtosis of either 0 or 3, depending on if we subtract 3 or not. And when we look at, I'm sorry about that.
Stealing my thunder.
Okay, when we look at that, I analyze the performance of our algorithms, and here we go. We have a mean close to 0, variance, 0.92, so we're slightly underestimating risk, but that's probably not even statistically different. Skewness of 0, okay, the first 3 were great. Kurtosis, okay, a little higher. Say, why is that happening? Algorithms seem to be working as advertised, but now when we look at prices in the market, we get the same type of kurtosis problem with the fat tails. So I say this is how we determine if an algorithm's working. And then finally, it's up to the investors to really employ pre-trade optimization models to help determine where you want to be, what algorithm you want to employ, and what you're comfortable with. Okay, thanks.
Thanks,
Sorry
Rob.
about that.
I'm sorry? Right, okay. It's back around. Okay. We're going to take a slightly different look of things. As we've already mentioned, I'm from Goldman Sachs, so I wanted to spend a little bit of time just going through what our development process is when it comes to algorithms, and then link that into obviously the topic of the forum, which is how do we actually figure out whether those algorithms are doing what they're supposed to. Pretty simple slide. I mean, the whole thing starts with idea generation. This is really obviously key to the whole process. We have 3 main channels from which we get ideas from our clients, in the form of smart, incremental enhancements to existing algorithms, but then also from our clients, like completely new custom algorithm ideas that are really tailored to their specific investment needs. We get a lot of ideas from our internal trading desk. Like our competitors, Goldman Sachs has a strong equity franchise business. We employ a number of smart and experienced traders. They generate a continuous stream of algorithmic trading ideas that can encapsulate and automate manual tasks, manual trading tasks that are either mundane and repetitive or simply impossible to carry out on a manual basis because of the amount of data that they have to crunch to actually be able to make the right decision to trade. And then from GSAT itself, everybody knows GSAT stands for Goldman Sachs Algorithmic Trading. Our business is run by individuals that have a lot of experience with significant block trading experience, both trading on the floor of the New York Stock Exchange, but also as NASDAQ market makers. We leverage that experience plus our observations in the marketplace, our impression of customer demand to come up with commercial algorithmic ideas. And lastly, but not least, and it's actually not on the slide, but I want to bring it up because I think you'll find it interesting, and this is beginning to create more and more new ideas for us. We learn a lot from our simulation environment, tying this into the theory of, or the theme of the presentation itself. In our simulation environment, when we're actually trying to figure out what is the algorithm doing, is it going to work, is it going to do what we're supposed to do, we have an excellent look at what the algorithm is doing and what is happening from a market microstructure perspective. And we're able to figure out more effective ways to make an algorithm more efficient, but then also completely new ways of thinking about trading. How we know it works? Well, firstly, the most important thing, production emulation. There are significant challenges here to overcome. Primarily, you can think of an algorithm as an input with a significant number of real-time, a function with a significant number of real-time inputs, such as real-time market data, volatility curves, liquidity profiles, cost models, the actual state of the order itself, the number of shares executed, the average price, FX rates for our algorithms that are trading involving currency, and then also a real-time theoretical stock model, which is evaluating whether a stock is actually particularly cheap or expensive at that time. All these things have to be emulated perfectly within the production environment. I mean, within the simulation environment, for you to really be able to get a good gauge of whether the algorithm is going to work. On top of that, an algorithm needs to be tested to a set of known business scenarios that generally follow and experiment with edge cases. Things like edge case order conditions, a very short-term order, a small order, or orders in a liquid names are particularly challenging, and they have to be ran through in detail. Edge case market conditions, simulating market open, market close, corporate actions, news events, Fed announcements. Obviously, with international trading in Europe, when the New York exchange is open, that's a market event that is abnormal, and that's something that we have to test for when we're evaluating algorithms. Neither of the previous two are helpful at all unless we're able to actually figure out from a performance perspective the price that the algorithm is going to get if we're able to evaluate that successfully. And then the last slide, the next slide, I'll tell you how we do that. One thing that is important to note here, we evaluate whether an algorithm is successful in the simulation environment exactly the same way as we do in the production environment. It's consistent. Automation is key. As we've already highlighted, algorithms are complex with a number of real-time inputs. The amount of tests that you have to go through to establish whether something works or not is large. You need to automate these tests. Not only do you automate the running of the test, you need to automate the evaluation of the results of those tests. None of these though substitute for testing in the real world. All of our algorithms will go through a substantial beta testing phase used by our internal trading desks, where performance will be evaluated on a minute-by-minute basis before we actually release it to our customer base. Final slide, measuring performance. One thing that I would like to just point out before we go through these bullet points, and it's actually something that doesn't just refer to apply to Goldman Sachs, it applies to the industry as a whole. Algorithms the usage of algorithms has changed dramatically over the course of recent years, gone from being a purely benchmark-driven situation where we're trading large orders over longer periods of time, i.e. VWAP, over-the-day VWAPs, to a world today where order size has shrunk dramatically, and people are throwing orders into algorithms for a much shorter time frame. It's important when we're talking about algorithmic performance that we make sure that we are measuring orders that are of a correct size and working in an algorithm for a correct time period. If we're working a VWAP for a short time frame or a shortfall with a high alpha stock, the algorithm will not perform well. So we have to make sure that we're testing the right things at the right time. That said, measuring and improving performance can be thought of as a function of the things that I have up here. It's absolutely essential that you isolate the different causes of slippage. Slippage falls into two categories: things you control, things you don't control. The things we control are things like what the algorithm is doing, and things we don't control, obviously, is the marketplace itself. Target market benchmark or non-market benchmark. Obviously, if there's a market benchmark, we have a point of reference to evaluate algorithmic performance. With a lot of the algorithms today, where there isn't a published market benchmark, either whether we're trying to we're going to an implementation shortfall type model, there's really there's no independent source that you can refer to. The way that we understand or evaluate algorithm performance is by looking back through the life of the algorithm and understanding at any given, reconstructing the input at any given point in time, and seeing if the algorithm made a sensible decision at that point. And once you evaluate all those decisions that the algorithm made, that's how we evaluate whether it is actually doing something well or not well. Simply standard deviation, not mean. We measure variance, not average over a period of time. The inputs that I have spoke about previously, they have to be measured and monitored and looked after with absolute care. The market data, the real-time market data, the latency around market data needs to be absolutely minimized. the volume profiles, the volatility curves need to be regularly updated and be absolutely precise. I mean, at the end of the day, the work is never done with an algorithm. The market is a continually changing place. So now even VWAP today, we measure it, the performance of it, as much as we did 3 or 4 years ago. It's a continual evaluation. We continually evaluate outperformance as well as underperformance. Yeah, as I said, we're focusing just as much on when we're outperforming the market as we are when we're underperforming. Okay?
Thank you very much, John.
Thanks.
And Linda, we saved the best for last.
Figure out how to use it. Hopefully this will work. I'd like to thank IAFI for inviting me to present and speak to you guys. Just a little bit about QSG. Can everyone hear me? No? I think I need a telephone book to stand on. That better? I'll try to speak. Okay, I'll speak up. I don't know if these work.
They do?
Uh-oh.
I don't know, technology. If I can't figure out the remote, I'm not going to figure this out.
We weren't told about the wireless.
Yeah, you could have used
Yeah, you
my
could
friend.
have.
Hello?
I would
Hello?
have been walking around the room.
Okay. All right, is that better? Yeah. All right. Just to give you a little background about QSG, we're an independent research firm. We specialize in stock selection and portfolio construction research, as well as implementation research, which specifically is transaction cost management, measurement, and all the associated details. We are in the unique position to evaluate and measure all of the buy-side trading. So we actually see what buy-side firms, what investment managers are doing. So we actually are evaluating all of these algorithms. So we see what's been happening in practice, not just the theories behind the algorithms and how well they work. We've been seeing some very interesting things. I put interesting in quotes because we see some of them work very well, and we see some of them don't work at all. And because it's more interesting to talk about, let's say, bad behavior, let's go to my first slide. Well, I can get it to work. Here are some examples of some patterns that we see, unfortunately, frequently, and I won't point out the clients' names, but here get the laser pointer to work. Oh, I can't that work too. Here on the right-hand side here, these are a series of trades that we actually received from one client. Actually, it was in over a 6-month period. Pretty much all of their executions look like this for one of their portfolios. Surprisingly, these were large cap names in very small orders, and these were algorithmic trades. These are the easy trades.
So you're saying they're highly liquid?
Very highly liquid. These are the eBays, Yahoos, NDX names. I just put up the sell orders here. The portfolio manager and the trader who sat down with us before we did the analysis told us that they actually did a good job because they pretty much were in line with VWAP every day. When we actually did the analysis, we found something else. They don't look at pictures like this; they just get execution results. And we see these big gaps. I'm sure you all see them too. And there's something going on. That's an algorithmic trade. And actually, this is one of the smart algorithms, and smart again in quotes, because we find that a lot of the algorithms, especially the VWAP algorithms, now have parameters built into them that will slow down or stop trading when the market starts moving against you. These parameters are not necessarily bad. It's just in this case because the orders are so small that they just stop trading. So in order to meet VWAP, you have a situation where you trade a little in the morning, and then to catch up, because there is also a parameter built into it that you need to be 100% complete over the course of the day. So what winds up happening is there's this hurry-up, catch-up at the end of the day. And in this situation, they actually wind up executing outside of the spread. So we have this situation here where it's just, and I wouldn't even call it best execution, but it's just not even good execution. And then we have these other situations here on the left-hand side of the screen. The sell order, this was a large position actually. This is a portion of the day where you just have, I think it's every 15 minutes, just executing at the low, creating these low spikes every 15 minutes. This again was another VWAP strategy. I'm not sure you would call that best execution either, good execution. If you're selling, you probably don't want to see a picture like that if you're getting your execution back.
Turn it upside down.
I would think so. Probably you'd want to do that. But again, the trader had no idea because they got a report back and they were in line with VWAP. And again, also with this buy order, this was actually something more in line with one of the odd-named algorithms that Rob was talking about, Tarzan, or one of the odd acronyms.
Swings high and low.
This one was executing on the way up and again creating market impact. Now again, I'm not saying that these algorithms are necessarily bad. It's just that for these situations they didn't apply. And I'll get into a little bit of our observations on how to write these situations or perhaps what went wrong. But we see a lot of this, unfortunately, these bad pictures in these situations where something happened. Just to move on a little bit, oops. And just to backtrack a little bit, what we find is that a lot of this is falling through the cracks because there is this adherence to these traditional post-trade transaction cost measurement methodologies. There's the volume-weighted average price, which I kept referencing, VWAP, which is probably the most popular transaction cost measurement tool. In itself, it's probably not too terrible, but you can see by the algorithms on the results on the prior page, you're missing a lot. You're not capturing what actually is happening. A very bad execution can wind up being in line with VWAP, and you don't know. There are any other point-in-time reference prices that you're just using in isolation, you're going to see the same situation. So I think what this tells us is that we really need to get to a point where we're using more sophisticated transaction cost measurement tools and getting to a point where we're using more methodologies that are actually bringing us to a point where we can measure what's going on with the algorithms. One thing that I'd want to get to, pre-trade costs as well. Every client that we have comes to us with the question, what's going on with pre-trade cost estimates, algorithms. They come to us with their hands shaking with all their pre-trade cost estimates and what went wrong when they have these things going on. And not necessarily that pre-trade, and I think everybody realizes that you need to do pre-trade cost analysis. I think the issue is that you need to keep in mind that I would say probably all of the pre-trade cost models that are out there are basing their estimates on history. And as every disclaimer that you read with almost every investment that you invest in, history doesn't always repeat itself. I think that's something you need to keep in mind. So I could go on and on about that, but I only have 10 minutes probably, which I've used half of. But one of the things, implementation shortfall, which actually is something that I think most people are familiar with, that probably has the most promise in measuring algorithms, and I'll get a little bit into that the next slide. But it needs to be modified a little bit. Implementation shortfall I guess its purest form will measure the whole entire investment period. Typically it's used, you pick a decision price, and then you build a paper portfolio and you measure what actually happened. However, if you want to measure your algorithms, you need to focus on the period where your execution strategy actually had price impact. So that would be the execution shortfall period or the period when you actually were in the marketplace. That will explain how the potential return, lost return. It will measure that price from the beginning to the end of the trading period, and it also will address this trader's dilemma, which I'm sure a lot of people have seen this curve. Rob mentioned it in his presentation. This is this liquidity charge versus timing, or market impact versus opportunity cost, or price risk. It really is this balance that every trader, every trading strategy needs to address when they're trading. How do I know what my trade horizon is? How aggressive or passive should I be? However, when you're measuring on a post-trade basis and you're evaluating a trading strategy, you need to get to these two costs. You need to get to, how do you separate that execution shortfall into these two costs, liquidity and timing, to get to what the actual cost of trading was. And we have a methodology that does that, which I won't get into too much, but I'll get into some of our observations, which will possibly explain those bad pictures on the first page. One of the things that I think happens with a lot of these algorithms is there's a mismatch between the investment style, or the precipice for portfolio construction, and the implementation strategy. These are some basic investment styles that we've grouped our trading universe into. And the impact costs, or liquidity costs, and timing costs. Just a note that timing costs are absolute values. One of the things that we've noticed, as you would expect, price momentum stocks are more expensive than out of all of them. But one of the interesting things, relative value and deep value, we separated out those two. There are factors that go into relative value, things like industry and sector impacts, that make that very expensive. It's important to consider, especially from a timing perspective, the factors that go into your portfolio construction, the factors behind stock selection, when you're also considering your implementation strategy. Because there's this alpha that you don't want to lose when you're actually trading. So that might dictate that for those stocks, you need to get much more aggressive. This is something, when you're selecting an algorithm, you need to make sure that there's a match between those stocks and your implementation strategy. One of the other things, too, and this is something that almost runs counterintuitive to everything that's been drilled into everyone's head for forever, slicing your orders into more and more slices doesn't necessarily mean that you're going to be reducing your costs. This is something that I think, back in the early 90s, I remember it was almost a mantra that you have to, the smaller the slices get, the less cost you're going to incur. Well, now we actually see, and this is something that across all styles, we actually notice that the more slices you slice your trades into, that you get to a point where it actually starts increasing your cost. We notice that that's actually because you're probably participating in more of the activity over the course of the day. At some point around 75 to 100 trades, slices per trade, maybe it's even 100 in some cases, the cost actually starts increasing. And that's both on the timing and liquidity side. So that's something also to keep in mind, that it doesn't necessarily, just because you're slicing your trades into minuscule little pieces, and this is something that's very endemic to all algorithms, this doesn't necessarily mean that you're going to be reducing your costs. And just one last point about that also. We also looked at this in terms of order size, or percentage of average daily trading volume. We noticed one of the things we also see with this trend towards slicing orders, even orders that are small, 0 to 5% of the average daily trading volume, we sometimes see these orders being sliced into hundreds of little pieces. We don't know why this happens. Again, we think that people just take easy trades and throw them into these algorithms every day. In some cases, we see them being sliced into 300-400 slices. This will start increasing your costs, and we see this pretty much across all categories. One of the things we notice in the larger sizes is that obviously if you if you have too few slices, you're going to have a higher cost, but there's this sweet spot in the middle at some point. Again, pre-trade analysis or more pre-trade categorization will start bringing out where that sweet spot is. And just to recap what the points were, that it's important to identify those two costs, liquidity and timing, because in identifying them, you'll bring out information that you couldn't get by just using a singular benchmark. Take into account style when you're putting together your implementation strategy, and also more slices doesn't necessarily mean that you're going to reduce your transaction costs.
Great.
That's it.
Thanks, Linda. All right. I have some prepared questions, and I'm hoping you have some questions. Just show of hand, how many questions are out there right now? All right, I'm going to skip my prepared questions because we only have about 30 minutes before the IFE members at least get to go have their cocktails. So somebody raise a hand, right here in the front.
Which reflects the best of approximation of fair value? Is it the VWAP or would it be the closing price? Or another metric?
So you're talking about fair value of the stock price?
Yes.
When we talk about any type of trading, any type of execution, I'm going back to just efficient market theory, that the market does a very good job at valuing companies, valuing stock. With that in mind, once I bring my order into the market, once I publicize my trade or order, either verbally or just by executions, that's projecting, again, temporary impact and permanent. To the extent that the closing price will consist of that permanent impact, it's a much better reflection of fair value than the VWAP, because the VWAP is going to follow you up and down. It's, in a way, a moving average that's has a definite start time and just end time that keeps going. So the closing price is going to include the market's valuation of the stock, which includes the information that any trader, any investor projects into the market. So with that in mind, the closing price is a better valuation of fair value for the stock. Now, it's also going to include a little temporary impact that hasn't dissipated yet, so it's not exactly the fair value, but it will be close. Much better than VWAP anyway.
Next question. Yes. Would you mind just...
My question is for Ms. Giordano. Can we go to the part of the presentation, the slide about relative value, momentum, and other indicators-based execution? I wonder what kind of relative value is meant?
Sure.
Do you want to try it? Who walked away with it?
Well, I handed it to Rob. I think he stole it. Sure. I think we're there. Relative value. Relative value is it's investment style that there are several factors that go into it. Oh, that better?
Yeah.
Okay. There are a couple of factors. Actually, I think there are 9 different factors that go into our relative value model. I probably can't list them all together. There are some earnings-related factors that go into it, but there's also a sector and industry component that differentiate that from a deep value type model. You know, if you want, I could probably, I could take your card and give you more information about what goes into our relative value component. The important thing there is that when you're differentiating between different value type models, or even within these different investment styles, there are certain factors that will actually increase your cost between the two. So even that's different level of specialization or differentiation will impact your cost because of these different factors.
Thanks for that, Linda. Yes.
Actually, I had a question on the same chart. Just the timing risk numbers there are positive. Is that a positive cost or is that a standard deviation measure?
They're absolute, actually, because timing actually is very dependent on a period. So we use the absolute numbers because it could be positive or negative. I didn't include the standard deviations just so the chart wouldn't look so crazy. So, but there's more variability in the timing numbers actually because they are very related to market conditions.
Okay, thanks.
Yes.
Hi, I know. Yeah, a question for all of you. I know that all the examples that you mentioned all apply to the equities market, but I'd like to know if has anyone tried this in the futures market, like especially like commodity futures?
Who wants to tackle that one?
I mean, yeah, absolutely. I mean, certainly, I think a number of people out on Wall Street have produced algorithms that work on for futures as well. Sorry, what was the last bit of the question?
It was about commodities, whether you tried it with commodities.
I don't know. I mean, certainly futures are a bit heavily involved in algorithms.
All right, thanks.
Yeah, we're also doing a lot of, we are employing algorithms for futures trading. I would say futures market is a little different than equities because the contract sizes are so large. The impact, I wouldn't say it's negligible, but because of the choppiness maybe? Of trades, it's already incorporated into that, we'll call it that spread.
I see. Does liquidity have a big
well,
effect?
just the sizes of future contracts.
All right. Thank you.
Yes.
Hi. I've read more than a few articles about algorithms when they're executing orders actually leaving patterns in the market, and you'll have buy-side institutions actually creating algorithms to detect those patterns. Can you kind of comment on that, on whether the markets are transparent enough to prevent that, or whether or not you actually think it is happening?
We've actually, yeah, I could say it is happening. We've noticed in one of our timing factor will actually pick out front running in a way that's not necessarily illegal front running, but front running that will there are more legal front running, people stepping in front of the trades. We've actually heard of situations where there are people using high frequency statistics to detect very normal volume for very small periods of time, and then they can detect what when that is increased. We've also heard of there are firms that are sending out probing orders that that they're able to detect it very quickly when increased order flow is coming down. Sure, there are firms that they're they don't have an investment strategy. Their strategy is really just to detect algorithmic trading.
It's a strategy.
Yeah, I'd say that's really a concern across the market on both broker-dealers and institutions and hedge funds. And a lot of it comes back to when I hear this footprints or detecting patterns, a lot of it comes down to VWAP. And I'll just start saying that first, VWAP is a strategy. It really isn't an algorithm. I'll say the algorithmic part really comes down to, I mentioned macro and micro decisions that need to be made. The micro decisions come down to order placement, order size. Do I want to float limit orders? Market orders, a couple of different strategies. Am I trading with a trade schedule or trading more with a percentage of volume? Most broker-dealer algorithms, I'm sure almost all, we're especially doing this, that we're taking special care in employing limit order models to determine the combination of limit and market orders, when to release to the market, how to release to the market, so we don't get into the problem that I believe Linda was saying, that you fall behind or you go too far ahead. We're also releasing market order sizes that are, we're not trading through the quote. Linda mentioned she does see that. And the other thing is on order sizes, we're really looking at the trade size distribution. This way we could really execute in quantities that are easily absorbed by the market and sizes that are most commonly seen by the market. I'm not saying that it can't be done, but we're taking special care. And finally, following that algorithmic decision-making approach that we're employing, that we're really doing a lot of pre-trade behind this, a lot of optimization. It's really difficult to assess that, let's say we did determine this pattern. I brought up an example where there were 3 different strategies for the same order: 25%, 20%, 10% percentage of volume rates. The order that's 25%, that's going to finish quick. Order that's 10%, that's going to take over the whole day. A lot of these algorithms, or once we uncover a pattern, we don't know if that is going to persist or not. So that's a big difficulty in trying to game algorithms. And I don't know of anyone who's doing it that well. But I do know every broker-dealer is really doing everything they can to disguise the intentions. And I say a lot of these concerns, like I mentioned, VWAP, is a concern for manual trading as well as algorithms. So it's not just something that's coming up with algorithmic trading. It's something that's also there for any type of prescribed strategy.
Thank you.
I think actually just one thing that I'd add to that, and I completely agree that an awful lot of time and effort is put.
I told you you're not allowed to say I completely agree at any point in the panel. Remember?
Oh, you did
John.
actually. Yeah, you did. Yeah. But it is true in this case. A lot of time is spent making sure that the patterns the algorithm takes is different each time it does it. One of the consequences of that is, from a testing perspective, the algorithm is actually never really doing the same thing twice. So when you're actually doing regression testing and understanding whether an algorithm is actually going to work or not, it's got a range of different activities that it could actually take place in. So that's kind of a downside to that.
Thanks, John. Yes.
This is kind of a follow-up question with that gentleman's question. It looks like no matter how good you disguise your order flow, the information already in the marketplace, as Linda's chart shows, you have different size slice. The 400, 500 slices clearly indicates that market participants already perceive the order flow. So if I'm market participants, if I look at the charts pattern like that, that's trading opportunity right there. I mean, how can you disguise that? I mean, what way you have to disguise the information already in the marketplace?
Yeah, I'd say something like that. Even if something's hard to disguise, I just want to bring up just a couple of points. I used to do a lot of evaluation of trading strategies before algorithmic trading, and the same type of patterns did emerge. You'd see that spike, you'd see trading down, 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 down. So something like that does occur. It may be more of a market phenomenon, not an algorithmic consequence. But also, getting back to this decision-making criteria, really understanding all the parameters. What am I looking to accomplish? My benchmark and market adaptation strategy. Just looking at Linda's first chart, myself, I've been doing this for a while. I can't conclude that that's poor performance. I know a lot of people say, "Oh yeah, that's horrible." I heard a lot of laughing in the audience. Said, "Oh, how could someone perform like that?" And the reason is if the investor really performed pre-trade analysis, really measured, the broker's algorithms, are they performing as advertised, and the broker was transparent and showed that this type of execution is highly likely. If that investor knew that that type of execution was highly likely and chose it because it best fit with their investment goals and long-term investment mandates, we can't really conclude that it's poor performance because the investor got exactly what they wanted. So it's really important for investors to understand what the potential consequences are and then make a decision based on those potential consequences. And until we understand what the investor's goal is, it's really difficult to conclude if it was poor or not. For whatever reason, without
how many
the
people out in the audience are buying that? nice try, Rob. But
no. In that case, I'd like to. I'd like for somebody to say, what's. It's my question in the audience. What's not to buy? It's about that.
We used to say, when you rate the customer, take off his shoes first.
Oh.
Okay, I don't know what that means, but.
Being nice about an excuse about something that turned out badly. That's what it sounds like.
What would the broker benefit? How would the broker benefit from that?
I'm not saying that the broker benefits at all, but I'm saying, look at it. It's a big mess. There
Okay.
Right. I mean, yeah. We have to be careful. It's one of the things I think we've all raised in our slide is that you can take algorithms work for certain types of orders. As we've just pointed out, the investor has the decision of what type of order he wants to put into the algorithm. The selection is not necessarily right. Then you can get strange dislocations. So without really, there's more to it. You can always find cases where you'll end up with a chart.
But the point is again that we can say the algorithm didn't perform well in that case, even if we can also admit that perhaps it wasn't the best choice for that execution.
Right, and I wouldn't even say the first part. And the reason is, if the algorithm up front is saying that this is going to occur, you're completely transparent, use this algorithm, high probability that this is going to occur. And that does occur, that algorithm is performing as advertised. So then it just becomes down to it may not have been the appropriate decision for the client. If if BDs say something's going to happen and it does, it's not, up front with the performance.
Can I have a very brief follow-up? I mean, my purpose is really, kind of criticize how brokerage firm does. I'm much more focused on, as an investor, as fund manager, whatever, right? Once I see the pattern, I probably identify tradable opportunity for myself right away. So I don't really care whether you perform better or perform worse. My question is related to Linda. Have you have intelligent guess as to why high frequency, more slices actually leads to poor performance versus somewhere in the middle actually have better performance? Is that how the market participants perceive the order actually coming down the pipeline? Is like a high frequency is more like indicates more clear indication, or like a less frequent and larger size indicates less?
There are a couple of reasons. I mean, I think you have to look at each investor separately, but in general, I think that a lot of it is it's this mismapping of risk. With a lot of executions, you're stretching out your time horizon. In a lot of situations, stretching out your time horizon is probably a mismatch between, you've got these stocks that are probably momentum stocks that you need to execute relatively quickly before there's all this information leakage. So you've got 300-400 executions, or you're using a VWAP strategy, or you're just executing for a longer period of time when you probably should just really hammer the stock, deal with the it's kind of almost with the curve that Rob was talking about, where you're executing very aggressively, incurring a higher cost, but you're kind of you get a higher cost if you execute it over the course of the day because of all the information leakage. So you're reducing the number of executions. You're executing in larger pieces, but overall your costs are going to be lower. I think that it's that time horizon issue that we are seeing this preponderance of VWAP trading. We're even seeing these hybrids that are kind of it's a VWAP, but then the trader takes over at some point, and then it changes to something else, or it's all of these participation algorithms, and it really is things that are just not really mapped to what the stock is, or what this strategy is for this particular stock. A lot of the things we see are this kind of I call it the over-the-wall theory. It's almost like you have all of these portfolios that are kind of consolidated and sent to the trader. The trader almost trades them all together, and without thinking of the strategies behind them. It could be 5 different strategies from 5 different portfolio managers, but then it all goes to the trader all at once. That really indicates that there's a mismatch going on. And then there's some other just even common sense things. You have 400 executions in a stock that might not be. Even if it's a stock is liquid, you think about the number of. You might be a small percentage of the daily volume, but if you think about it in terms of the number of trades, we've seen situations where you're only 5% of the daily volume, but you might be 25% of all of the trades over the course of the day. In that situation, you're going to have a big footprint. So, the things to consider when you're trying to, minimize your footprint, minimize your execution costs that way.
Okay, here and then there.
Yes, I'd like for you to comment on stat arb strategies with hedge funds and their role in this. And it would seem that in a lot of instances, they're creating a lot of volatility, which is exactly what they want, and also driving up the cost of the asset. Sets them up for a great short on the other side. So like for you to perhaps comment on that, and maybe also the drive to self-clearing for hedge funds.
I can comment on the analysis that we do for stat arb firms. They tend to do really well. They hammer the stocks really hard. They get in when they should. I think that I don't think that they're necessarily doing the pre-trade analysis. They're very big on doing the probing orders. They have no afraid. They're not afraid to get in and put those orders out and almost they ping the market. And at the first sign that there's almost they get a bite, they'll just hammer the stocks, and they do really well. We see them having significantly high positive timing, meaning that they're getting in the stock and no one else is in the stock with them. So that they tend to be there before anybody else. And it's almost that the trading, they could do better on the trading side, but because their timing is so good that it kind of overpowers it. So I think that they're actually there's a lot we could probably learn from those strategies in some ways. But it really is, it's almost like they're, it kind of compensates for the trading strategy that perhaps they're, they could always do better. But, I think that they're, it's almost like that they're taking advantage of everyone else's perhaps, not being as wary of it in some ways.
How about you guys? Comments on stat arb? No. No. Okay. Orange shirt.
Hi, I actually didn't understand why mixing the same stock from different strategies is bad. I almost assumed that a particular stock would belong to only one strategy. I mean, if something is deep value, it's deep value. It has no price momentum.
Not mixing the same stocks, mixing all different stocks from different strategies. So if you have five portfolio managers and they're all trading different stocks, they'll just combine everything in one list. And then what will happen is the trader will have one master list, and then perhaps they'll break some of it up and farm it to different brokers, but sometimes it's all traded as one big thing on the trading desk. We see a lot of that happening. It's almost like this economies of scale. Perhaps they don't, it's easier for them. And it doesn't necessarily, in a lot of cases, it's going to result in a situation where you're not paying attention to the underlying factors behind, why the stock is, why you're trading the stock. So what happens is everything is traded the same way. All the trades that are kind of deemed to be easy, perhaps because they're all large cap, even though they're different investment styles, are VWAP'd or sent to whatever they consider to be their, perhaps they're paying for research, whatever they're doing. And that's not probably the best way to be implementing your trades.
Right.
Down in front, yeah.
First, a quick comment regarding stat arb, if you don't mind. If your impression is that stat arb is creating volatility, I think it's the exact opposite. And the best evidence is you can see that the implied volatility in the market has been going down over the past few years as the number of stat arb players have been increasing. In general, most of them are mean reverting strategies, so that's actually dampening volatility. Now I have something to the panel. Robert and Linda, both of you used the phrase the market moving against you or against the order. I want you to clarify exactly what you mean by that, because if the example you had, Linda, that someone is selling the stock, if the market is moving up, you consider that moving against you or not? Because if I'm selling the stock and the market is moving up, yes, I'm getting better execution costs, but the market is not really going against me. I'm expecting it to be going down. Otherwise, why would I be selling?
Well, no, then you're selling into a favorable market if you're selling into a market moving up.
But my impression from both of you was that when you said the market is moving against you, meaning that the market is actually going up as you are selling, or is it the other way around?
If you're buying and the market's going up, it's moving against you. It's making your executions more costly.
Right, that was my understanding from what you said.
If you're selling and the market's going down, that we refer to that as going against you, because your sales are becoming more costly. You're not recouping as much money as you could have.
Right, but I am actually making money. I'm having a higher transaction cost but I am actually making a profit. If I'm buying and the market's going up, that was my expectation. The market is more moving as I expected it to. So I just wanted I think the term is a bit confusing, because you do incur higher slippage, but you also, that's what you want it to be. I mean, you're not going to be buying if you expect the market to be going down, right? Even though you get better execution costs that way.
Well, correct, but you don't want to be buying to the point where you're pushing the market up, and you're actually, all the return that you expected to get out of the stock is negated. So you don't want to be buying into adverse market conditions to the point where it doesn't make sense to buy the stock anymore. I think you're willing to accept a certain level of adverse price movement.
Right. I mean, I think basically, I think what you said, you dissociated the alpha that the trader has from the slippage, basically. So you were just concerned with how was the execution, whereas I think as a trader, I'm much more concerned how was my P&L at the end of the day, include, of course, slippage is part of my P&L.
I say I don't even mean any of that. It's just the terminology. When the market moves against you, it means you're buying and the price is going up, and selling and it's going down. Just the terminology. But you have points that are even more important, and that gets involved with choosing not just an algorithm, but just the best type of strategy. Those concerns are extremely important and will dictate that your preferred optimal strategy.
We only have time for one, maybe two more questions, so let's take this one in the back.
Yes, this question is for Linda. Suppose you're selling and the market's moving down. Now, maybe the market's moving down because it's last Friday and it was the Russell rebalance. Mm-hmm. Is that necessarily bad? Especially if your benchmark is the closing price on Friday and you're doing really, really good, but your report based on this analysis might be very, very bad because you had the impact from doing those 200 trades.
Well, sure. I mean, I think that, certain situations, there's going to be a transaction cost. And, on that day, well, the Russell rebalance is kind of a special situation. If you're trying to get that closing price for a particular reason, you're going to have to accept a certain level of cost. You're going to have to, accept that you're not going to, you're going to execute within you're going to get not the best price.
But does your report reflect that? When the customer gets that report at the end of the day, does it actually reflect the fact that he or she did really well, despite the negative impact of that you're reporting?
Well, that's something that we take into consideration, especially if we're doing analysis on a daily basis. If it's a rebalance day, we're analyzing a Russell list. It's of course that would be something we take into consideration. It would be something that we noted.
But do you take that kind of consideration on other days, such as triple witching or quadruple witching and whatnot? Does that go into your formula?
Well, it's not something that would go into the formula. Because it's part of the daily analysis process. I think it's something in special situations. It's something that we would take into account as far as understanding why the costs were the way they were. But I'm not sure what take into account means, normalized for the market conditions or
meaning that the fact that the market's going down when you're selling is not necessarily a bad thing.
Well, no, it's not.
But it seems from the impact analysis, it appears to be that it's universally a bad thing.
Well, I think what would happen is you would see everybody experiencing that same level of cost. It wouldn't just be you. I think what you wanted to get to is a point where you'd understand what the normal level is, and did you exceed those or not? I think that there are a few ways that you could do that.
So I guess the conclusion is the world is all relative.
In some ways.
Okay, I'm sorry, I have to really cut us off now because we've run out of time. I'd like to really thank our panelists, and just to recap very briefly, we had Rob talk about Trader's Dilemma and the efficient trading frontier and the different ways that they look at evaluating trading strategies, along with stressing the importance of brokers providing a lot of transparency around how the algorithms work so that you don't end up with a situation where you have an algorithm applied in a bad situation. John talked about where they get their ideas and how they know they work, and stressed that it's a continuous process evaluating these algorithms. Come on, you guys, I didn't do any opening. You have to listen to my brilliant conclusions. And Linda talked about why some strategies work and some don't, and why strategies provide, or algorithms might provide, not superior executions, but not even good executions. And I think in general it was great to hear the different perspectives. We got a lot of great questions, and I hope you will join us for cocktails. But before that, I know David wants to say a couple things.